Worries over inflation and higher interest rates have sent the stock market crashing back into the claws of a bear market. So what does that mean for you and your money? Financial advisor Jeff Bangerter joins us now live to explain why this happened and what money-making moves we should consider right now. Good morning to you, Jeff.
Good morning. Thanks for having me.
Definitely. So when we see all these stock prices dropping, it's tempting to run out and buy right away, thinking we're all getting this great stuff at a discount. But prices may not have bottomed out just yet. So what about not buying too quickly? I know you want to buy low and sell high, but you don't want it to go lower after you bought, right?
Yeah, it's kind of funny. Really, most investors are driven by emotion. It's either greed or fear. And so you can do one of either bad things, right? You can get afraid right now and think, oh, I'm going to sell. I don't care how bad it is. Or you can get greedy and say, I'm putting all my money on XYZ stock. And you just really have no idea where it's going tomorrow. I mean, we're getting a little bit of a bounce today, not dramatic, but, so dollar cost averaging really is the best solution for most people. Take the money that you don't have in the market and put it in a little bit at a time. And if you're in the market, don't freak out. It'll come back. Just hang in there.
And it's a good time to think about diversifying your holdings, right? This is going to help us minimize loss.
Yeah, you want to look at your time horizon mostly. So when you think about it, right, during your working years, you're building up your 401k or your IRA or just not regular non-qualified monies with the intent that at some point in time, you're not going to work. Well, retirement could last 20 or 30 years. And so you have to look at that entire time horizon. Now, most people, as you get at or near retirement, you want to start getting more conservative. And so the rebalancing, I think, is more of a time horizon than a volatility in the stock market. Again, people get the fear kicks in or the greed, one or the other, and they try to do too much. I would say look at your holdings, but don't really necessarily act on it.
Bear markets often come just before recessions, and consumer staples and utilities are more stable during bear markets. So those are places to look to invest right now?
Again, I think it's based on your own time horizon, but I do think the big concern, right, most people look at bonds as a safe haven during down markets, and yet as the Fed increases interest rates, bonds will lose money. They have so far. It's been a pretty tough year, actually the worst year, I think, in quite a number of years for bonds. And, adding more right now, it's likely the Fed's going to keep increasing rates. So doing something, a high dividend kind of a strategy might be a better place than going directly into bonds at this point.
Got it. And I know you've said it a couple different times, a couple different ways, but the hardest thing to do right now is to not be emotional and really focus on that long-term goal.
It really is. Investing and savings are really a long-term strategy. If you need money for, to buy a house next year or a car or something, it shouldn't be in the market anyway. You should be looking at the long-term effect of investing and thinking 10 and 20 years down the road. And then these drops in the market are really just buying opportunities. Again, don't get too greedy because we don't know if this is bottom or not.
All righty. Well, thank you so much for your insight this morning. For all of us nervous investors, we appreciate you. Luckily, bear markets usually last less than a year. So we'll be checking back in with you. Thank you very much.
Thanks for having me.